Hey everyone, happy Monday and welcome back to another episode of What's Moving Your Money with Forbes. We have a very busy week ahead, but first, over the weekend, we got a very big trade announcement between the United States and the European Union, the first and third largest economic blocs in the entire world, only sandwiched by China. We're going to cover the details of this trade deal. We're going to cover what it means for markets, for consumers, for businesses, who really is going to pay all of these tariffs when it is all said and done, some currency market fluctuations that are more important than you think, and then after that, we are also going to talk about the upcoming Fed meeting this week and whether or not we can expect any dissents. I think we can, although they're relatively rare. I think it is ripe right now to get some dissents. So sit back tight. I hope you guys enjoy and welcome back. So yesterday we got the announcement that the United States and the European Union have agreed in principle, to a trade deal that will cause 15% tariffs on any and all imports from Europe into the United States. And in addition to that, the European Union agreed, or at least the United States claims that the European Union agrees, to buy $250 billion per year worth of energy products from the United States. Let's break this all down. So first, the terms of the deal. Anything that gets imported from Europe into the United States going forward is going to have a 15% tariff on it. Let's break this down slowly. Europe did not agree to any retaliatory tariff in exchange. This is being marketed as weakness by some. And look, if you want to call it weakness, sure. If you want to live in a dog eats dog world, then sure, this can be weakness. But think about this a little bit more on a higher level. What does Europe have to gain by tariffing the United States? Why would Europe go and raise their own consumer prices, raise their own businesses' prices? What is there to be gained by such a thing? Look, in the United States, we are already seeing the early signs of all of these tariffs, all of these price pressures passing through to American businesses and American consumers. Why would Europe want to copy such a thing? Beyond that, I think Europe actually got somewhat of a strong concession that no one is talking about. After the fact that the United States and Japan agreed to a 15% auto tariff on the Japanese auto sector, remember, the other major car manufacturer around the world, except for China, are the Germans. Mercedes, Volkswagen, Porsche, Audi, all of these companies are German. If they were going to continue paying a 25% tariff, which was the rate had there not been a deal, while the Japanese agreed to a 15% tariff, they were going to disadvantage their own auto sector. And as we know, Germany is heavily reliant on their auto sector, not just for jobs, but it's also for GDP. It's also global power. It gives them leverage in the world. It sends their soft power throughout the entire world. So it is something that is quite relevant to the Germans. Now, let's dive a little bit more briefly into who exactly is going to be paying these tariffs, because we got a few very interesting studies over the weekend, and I think they're really worth covering. So over the weekend, Deutsche Bank and Citibank, so a German bank and an American bank, came out with two separate studies that essentially both confirmed the same conclusion. I think that's very valuable, because when you just have one entity confirming a conclusion, how much can it mean? Because their study can be wrong. They may have their own biases. They may be talking about their own book. But when two entities come to the same conclusion, it further validates that. Essentially, what they said and their findings were that of the tariff pass-through so far, American companies are paying 60% of this tariff, and they are mostly paying it in the form of lower profit margins. Now, this is incredibly important because up until just recently, Americans were still selling the pre-brought inventory that they bought during that grace period from the Chinese, from the European, from the Japanese, from the Brazilians, from the Canadians, from the Mexicans. So it was not affecting their margin. But as they've depleted that inventory, they are now replacing that with fully tariffed inventory. And what so far they are choosing to do is they are choosing to lower their own profit margins in order to not raise prices substantially on Americans. Now, as consumers, we may think this is great, but we also have to consider the fact that when profit margins at corporations fall, they have to start laying off people. Remember, these companies are mostly publicly owned. They exist for the benefit of the shareholder. Whether it's right, whether it's wrong, the majority of companies in the United States do not exist for the benefit of the employees. They exist for the benefit of the shareholders. And shareholders will not accept a lower profit margin. It is too competitive of a world. There are too many international competitors. The executives of all these companies are paid in stock. They care about the stock price, and they will be punished by the stock price if their profit margin and their actual overall profit falls. So what is the easiest way for a company to protect its profit margin? It's by laying off the worker that was making $80,000. It's by laying off 10,000 workers that were each making $100,000. That is how they protect their margin from getting hit. So yes, the vast majority of this is not yet being paid by consumer, but don't get it wrong, it's being paid by Americans. And one way or another, if you have a 401k, if you work for one of these large companies, if you work for a company that is a vendor of one of these large companies, almost everyone in the United States has some vested interest in corporate America. Whether it's right, whether it's wrong, whether you like it, whether you don't, it is simply reality. And if they get hurt, we all get hurt. It's not zero sum. Like they get hurt, we are also going to get hurt. But it gets even worse than that. Beyond that, the study from Deutsche Bank and Citibank showed that 30% of the cost is being directly passed through to American consumers. You can see this as an example on Walmart, on Amazon. There's been a very popular receipt going around from a coffee shop in Reno, Nevada that is now itemizing the tariff costs within the price of the coffee. You're going to see it further and further because frankly, we are settling in a world of 15 to 20% tariffs, and businesses do not operate at 20% profit margins for the most part, so they're going to have to pass some of this along. And then the balance of 10% is being paid by foreign producers. Now, this is actually quite logical. The manufacturing that is not done in the United States is generally lower level manufacturing. It's lower profit margin manufacturing. There's a reason we don't do this. Why is it that we do the most complicated technology manufacturing in the United States in Silicon Valley, but we choose not to do hardware for iPhones? Well, it's because the value is in designing chips. The value is in designing user interfaces. The value is not in assembling USB ports. That is not where the value is. Believe me, if it was valuable, we'd be doing it in the United States. The United States is the essence of capitalism. If there was enough money relative to capital and relative to risk to be made doing something, we'd be doing it. We wouldn't be sending it overseas. We are sending it overseas in large part because it isn't worth our time, right? And you can see that manifest in prices. They just simply do. The person that is making underwear in Vietnam does not have enough profit margin to swallow 100% or a 40% tariff. It's just simply not possible. Let's leave tariffs to the side for now. We've spoken about it enough, and I'm sure we're going to be talking about it more this week. Let's talk very quickly about Fed Dissent. We have a Federal Reserve meeting this week. They're going to keep interest rates on hold. All markets suggest that. Futures markets suggest that. Betting markets suggest that. Interest rates swaps suggest that. Everything more or less suggests that. But we have Chris Waller, who is essentially auditioning to be the next Fed chair, who is very likely to dissent this week and go against Powell and say that interest rates should be cut this month. Now, he is doing this whether or not he actually believes it, because he knows that in upcoming May, when the next Fed chair is picked, Trump is only going to pick an uber dove. He wants to position himself as the biggest dove on the current Fed board so that he can be in the middle of having some institutional credibility as a current member of the Federal Reserve versus someone like a Kevin Warsh, while at the same time posing as this uber dove that will do Donald Trump's bidding for him. So I think you can expect some dissent at this Fed meeting. It is not significant. The policy is going to stay the same, but it is symbolic, and it shows you again where the overall trend of monetary policy in the United States is going. This is not a Democrat or a Republican thing. Both parties, in my opinion, are guilty of this. But over time, you are getting Fed members and possibly even Fed chairs that are very partisan, that are there to do what the president at the time wanted them to do. And you're ultimately going to pay for it, as we've said in previous podcasts. So guys, that's all my time for today. We have a lot of episodes to cover this week, so I want you guys to stay tuned and please tune in. And if you have anything you guys want me to talk about, you're going to let me know in the comments section on Forbes, on my Twitter page, on my TikTok, on my Instagram, wherever you find this, on Spotify, on Apple Music, wherever. You drop a comment, you let me know what you want to hear, and I work for you guys always. So thank you guys and have a great day.